Welcome to the Best of U.S. Investors Platinum Trading Technical Analysis call today. This is Mark and I am Trent, and we're just two regular guys navigating markets and creating wealth. And today we're going to get into some economics conditions. We're going to talk about this past Friday's Platinum Tribe members portfolio stock pick session, where we decided on, as a group, some of our favorite picks for the 2025 year, long-term holds, and why we picked them. And we're going to go over that, along with maybe we'll touch on my daughter's question of why is the US dollar going up? In the meantime, let's get rolling. Hey, Mark.
How's it going?
I'm stumbling over words today, Mark.
Stumbling over words. Deep
This cold
thoughts with
weather
Trent
in
Greatfire.
Florida is driving me nuts.
At least you don't. I mean, we're sitting around, feels like 1 degree here today, so we'll see.
Well, yes, we're in the 50s today or 40s this morning, and so
You
it's
poor
supposed to
guy.
be cold for another week or two, but hopefully warm up soon. So,
That's why
what's
you
on
live
your
in
mind
Florida.
today?
That's why you live
Yeah,
in
well,
Florida. Well,
oh, woe is me.
let's start with the Santa Claus rally that wasn't okay, and then the first 5 days of January in the S&P are supposed to be another sign if they're good, that we're going to have a good year, and that wasn't. And then the third thing is the whole January itself and how it works, as far as predicting the rest of the year. And so far, we're not doing so well, and a lot of that has to do with, uh, in my opinion, the sell-off in the global bond markets that's accelerating, and it's fueling concerns over government finances and raising the specter of higher borrowing costs for consumers and businesses around the world. And we just before we started filming here, I mean, the 10-year Treasury was down this morning on the PPI, and we'll talk about the PPI here. But now it's back up to 4.8% on the 10-year Treasury. Um, and you look at the markets, and last week, the markets, were not good. And then yesterday, which was Monday, the markets didn't do all that well. They came back a little bit. The Dow did well, but that was because of one or two stocks, Amgen and United Health. Okay, otherwise the Dow wouldn't have been uh, doing so well. When you go and look at global hedge funds, last week global hedge funds added more bets against U.S. stocks uh, through January 9th, and that's ahead of the jobs report that we'll talk about here in a minute. And that jobs report sparked the sell-off on Wall Street. And the reason for that is because it was such a hot jobs report. How can the Fed even think about lowering rates anymore? And then we've had Fed speak out there over the last week about just that. How can we lower rates anymore? With the economy doing so well. Uh, so anyway, I think it's all about rates right now and treasuries, and I think the treasury vigilantes are out there telling the Fed, this ain't working for us. You got too much debt, printing too much money. Uh, and until that happens, if you keep lowering rates, that's just going to cause more inflation. And we don't agree with that. So, what's your thought on that?
Well, I think, I've always believed the bond market is the truth. It is the leading indicator of um, fear or anxiety or hope and positiveness. And I look at the fact that people are, the 10 years at 4.8%, and it continues to move higher since the September Fed meeting, tells me nobody wants our stuff. Nobody wants to pay, if they're going to pay to hold treasuries, they want to get paid more for holding them. They want to get paid risk. I mean, you look at high yield debt is the yields are so high because the issuer of that bond is a risky company or a risky country. So they have to pay more to get people to buy it. Well, we're in a point now with the US Treasury is a lot of people are looking at us saying, we're not on stable ground. We're not on financial stable ground. And the way you guys are spending money and printing money and borrowing money tells us that a reckoning is coming. So if we're going to own your treasuries, you're going to pay us more for them. And now you're seeing that. The unfortunate part about it is that a lot of the US, you know, investors have been told bonds are safe, and if you've held bonds in the last year, you're losing money. And those 60/40 allocations are losing money because of that bond portion, and that's dragging down their overall returns. And I think this is I mean, you had a 30-some-year-old bull market in bonds. It's now going the opposite direction. And a lot of it's fueled by how we manage our finances in this country. So I see 5%, and if we hit 5%, all housing market gets squished, commercial real estate gets squished. Anything tied to the 10-year treasury when it comes to lending takes a beating. Um, all of those loans that are tied to it that are coming due to be renewed, they're going to pay a lot more. So it's a problem. And I think the bond market is telling me that your economic situation in your country is nobody believes in you anymore. They're losing faith.
And what it's doing to the equity market is traders and investors are saying, well, if I can get 5% on the long bond 10 years or more, then my equity risk is high because why would I go put it in equity on average you make maybe 7% when I can make
Yeah,
an easy cool 5% or more, on a 10-year bond. So it's stealing money away, as the bond yields go up, the prices go down. And so it's stealing money away. People are investing in 10 years of 5 or plus percent. And if the bond market the yield ever went back down, they're they have a premium. Okay. It's not a
yeah,
discount. They can sell that as a premium. So it's kind of it's a bad situation for the equities too. And it all comes down to in my opinion, with the equity market, the Mag sevens, the valuations of the Mag sevens, which have run our market, our S&P and Qs up the pole for the last 2 years. Okay,
yeah,
and if there's a glitch, and we're starting to see it in the charts, if there's a glitch in earnings or expectations, forward guidance, uh, and if those start falling, those Mag sevens, then it relies on the 435 other stocks within the S&P to make up for those earnings, and I don't think I'm going to see it. So again,
yeah,
going to be interesting. Can these growth stocks, these mega cap stocks, continue with their revenues at these exuberant paces to justify their valuations? And I can't say one way or the other. We're going to know in a couple of weeks. Earnings are coming out. Um, but again, we'll know soon enough when the banks and the regional banks start reporting about, especially the treasuries. If I'm like Silicon Valley Bank or many of these banks who hold all my cash reserves in bonds, and the bonds are at, expiring at 2.5% because that's where I bought them, and now I've got to buy them back at 5%.
yeah,
I'm underwater on those bonds. Okay, and if
yeah,
people start coming in for their money, which you're starting to see people are, have moved money, into other areas such as crypto, Bitcoin. We'll see what happens there.
yeah. I think, you know, yesterday, one of those variables that came out that you reported on in the morning news was Biden has decided he's going to, limit where NVIDIA can sell its chips to. That is hindering business. Now, granted, he's doing some stuff in the last moments of his um, tenure that are a little off the rock,
A little
I think are
questionable.
crazy.
Yeah.
Yeah, very questionable. And it doesn't mean they won't be reversed, with the new administration. But when you tell NVIDIA you can't sell your chips to China or some other country, that takes away from their revenue and earnings per share growth eventually. I mean, that translates down. Um, and that's a big part of their business. So that then triggers other, companies in the Mag 7 to head downward. So
And then, on the macro look, when he comes out and says they're going to pay the U.S. government, us taxpayers, are going to pay 100% for the first 100 days of everything, and in what's happening in California, the fires, and spare no expense. Where's that money coming from? Okay, so we're printing more money for that. Okay, and if
yeah,
we're printing more money, we're just devaluing our currency more. Okay, uh, and then on top of that, banning, any kind of offshore oil exploration pretty much throughout the entire coast of the United States, all the way from Alaska back around through the Gulf and up to Maine, uh, which is hand tying our ability to utilize the petroleum resources that we have, which will cause, if that remains in effect, a shortage in petroleum around the world and potentially higher prices and more inflation in energy prices. Okay,
yeah,
so again, we're not out of the woods yet. There's still a few more days before the transition of the new government coming in, and hopefully we'll see some improvements. But there's a lot of stuff going on. There's a lot of governing in the last 30 days from this administration that I hadn't seen in the first, three years and 11 months. So we'll see what
yeah,
happens.
yeah, yeah. I think I think you have to expect our economy has been slowing. Inflation for the regular, Joe out there is going up, and so consumer spending is going to slow, which means eventually corporate spending is going to slow, and it's going to affect these earnings. And I would not be surprised if you see a lot of the Mag 7 stocks guide lower at this quarter's earnings reports. It would not shock me. I haven't done any research on it, but I'm really curious of how much are people hedging out the Mag 7 in anticipation of that happening. You
Yep.
know, that would be, I know I'm seeing more volume on longer dated options in on the Nvidias and the Teslas of the world. And then maybe it's big institutions hedging them, their positions out so they don't get clobbered.
Yep.
So,
And on top of that, we got big banks starting to report tomorrow, and I'll be looking at how much debt are they writing off from consumers, whether it's
oh yeah,
credit card debt or defaults on car loans or defaults on housing or whatever, because we've seen that gone up too. The delinquencies and and bankruptcies of small businesses has gone up. So again, put all these pieces together, and we're still not out of the woods yet, in my opinion, on where this economy is, even though Steve Leisman says we're in the best economy we've ever had in the entire history of the world. So
he probably said
anyway,
that in '08 as well.
yes, he said, yeah, he did. And again, I was talking
As people
earlier,
are getting thrown out of their homes. Oh, this is
you
great.
hardly,
The housing market's great.
yeah, I mean, you hardly ever see on CNBC halftime report any of their analysts talk about anything as far as, going down or I'm getting out of this or something, because it doesn't sell. Everything is happy and up. Uh,
Yeah.
Meanwhile, retailers push in and hedge funds get out and the rug gets pulled. And I have a feeling that we're heading towards that rug pull here for retail investors. So just be careful out there. Again, it's just my feeling and not financial advice, but manage your risk accordingly.
Well, and I think if you just look at charts, go look at a weekly chart of your favorite companies. And if you span out over a 5 year period, you can see the behavior, the pattern, what is happening. If you look at NVIDIA, you go back to September of was it 21? It rolled over, it bottomed out, October of 22 and moved higher and has been since then. But now it's trading sideways on a weekly chart and has been for a while now. Um, just
This is one
it's just,
that this is one that got me was Microsoft.
yeah,
Microsoft's been trading under its 200-day simple moving average on a daily chart. Okay, which if you were Paul Tudor Jones, you would have gotten out. Okay, that's just a
yeah,
that's just a sign going from bullish to bearish, and here's where we are. And we're just kind of trending along a support level, and if we break that support level, off we go down to the lower Bollinger. So again, uh, when we look at the mags, here's one of the mags that's actually broken through on the daily, the 200-day simple moving average.
yeah. And I think that's what, as an investor, you have to have that process of how do I protect myself? You know,
Yep.
this is a daily chart of NVIDIA.
This is a daily chart in NVIDIA. And if we went back, let's just go back a year. And you can see we've been, even back here, we hit this resistance level, and this was back in June. And then since then, side by side, we came back up, hit resistance again in October, came back down, up again, right here on resistance, and here we are below it again. Look at all the oscillators. Okay.
Yeah.
They all look pretty bad. So again,
And
you go to the
th-
weekly.
I think this their stock price rolling over isn't a representation of do they make a good product. It's a representation of how the market values this stock. I mean, this has a PE ratio of I think 42.
Yeah.
That means you're paying um for earnings 42 years in the future. I mean, what's the average PE ratio? I mean, people throw around PE ratios like it's, God's gift to green earth,
Yep.
but what's the average technology index's PE ratio? It's probably historically right in the 20s, 20 to 30 range. So if Nvidia is in the 40s, that tells you it's overvalued in relation to its benchmark. There's a better opportunity to buy a great company down the road. And I think that's what you got to consider here.
Yep. And I think you look at oscillators, they're all looking down, just like
Yeah.
we've seen before. Let's go to we're just on the mags. There's Meta underneath the 9, again, a daily chart. Okay. Oscillators going negative on us. Okay. We've had some good support right here on this 50. If it breaks the 50, it keeps touching it. But the oscillators are looking down.
Yeah.
Again, we'll see what happens. Just more decisions. Apple's having some competition over in China, had to lower their prices, and see where Apple is, riding right down the Bollinger Band. Okay. So again, downward trend on Apple, downward on the oscillators. Google underneath the 9, hitting right here on this resistance level again. Even with
Yeah.
Google, oscillators aren't looking good. Okay. So I look at all these from a short term daily look, and it's not looking good to me on these. Let's go to a weekly, maybe on Google, and you can still see we're still hitting this resistance level on the weekly,
Yeah.
but the oscillators look a little better. So on a weekly, again we hit it resistance back here, and this was in July, and we're hitting it again. So these resistance level mean something, and everybody can see it. You know,
Yeah.
so just be careful.
Yeah. And I think
So
that's
that's why I'm a little alerted right now. It's we're not seeing that momentum zinging us up anymore on the max.
yeah. Well, and since they represent 40% of the moves in the S&P 500 on a daily basis now,
And over
I mean, that's a
fifty
big
percent in
chunk.
the Qs.
What's that?
And over 50% in the Qs.
Yeah. I mean, the world is all dependent on seven companies. And if the charts are showing us exactly what we pointed out, you have to take caution. You have to, if you're a S&P 500 owner in your 401k, how long till retirement do you have? And how long do you have to recover any downside loss? Does it mean you get out of the S&P 500 100%? No, but it means you maybe take some profits and look for better and sit on the sidelines and wait. There's nothing wrong with that at
I do
all.
it all the time. Yeah.
Yeah.
So let's talk a little bit about two reports that came out last Friday. The non-farm payroll report came out and just tanked the market. Well, it came out, it was red hot. It was 256,000 new jobs. Their consensus, I believe, was about 165,000. Of course, we had some revisions in October that revised it up 7,000 from 36,000 to 43,000. But in November, they revised it down by 15,000 to 212,000. So with those revisions, employment in October, November combined was 8,000 lower than previously reported. The unemployment rate came down to 4.1% from 4.2, and the estimate was 4.2%. So, the non-farm payroll report is an interesting report. It's been all over the place, high, low, revised all over the place. February 7th, we're going to get the revision for Q2 of last year. Q1, you remember, was revised down 818,000 jobs. We'll see what they do in that time. But you've got a household survey and you've got the kind of the institutional report. And the household survey, they actually call households and say, how many people are employed? How's it going? Okay. And then on the more of the institutional side, they call businesses and get surveys. Well, since COVID, I think the return rate on the business side has gone from like 70%, response rate to about 30%. So it's really skewed the data. So when you look at this 256,000, that comes from basically the institutional side, the business side, and the Bureau of Labor Statistics does a lot of finagling with those numbers and estimates that aren't really given to them by businesses. So when you look at the household survey, you get kind of a better look. Okay, so in December, the number of long-term unemployed, and this is from the household survey, those jobless for 27 weeks or more changed a little at 1.6 million, but is up by 278,000 from the year earlier. The long-term unemployment accounted for 22.4% of the total workforce. So think about that. I mean, these are the household surveys, people calling houses, the government calling houses and asking about how many people are working actually in their house. There's really no reason for them to lie about any of it. So when you look at the number of people employed part-time for economic reasons, that's at 4.4 million. Okay, little changed over December. And I'm seeing in the household survey, everything's little changed, where on the institutional side survey, you're seeing all these big numbers that it's hiring left and right. It's little change in December and a little different from a year earlier. These individuals would have preferred full-time employment, but were working part-time because their hours had been reduced or they're unable to find full-time jobs. So again, 4.4 million, little change. Number of people not in the labor force who currently want a job is at 5.5 million, and that was unchanged in December. These individuals were not counted as unemployed because they were not actively looking for work during the 4 weeks preceding the survey or were unavailable to take a job. So there's 5.5 million people we don't count as unemployed. So, that works out well. And the labor force participation rate was at 62.5, unchanged over the month, and has remained in a narrow range of 62.5 to 62.7 since December of 2023. So when you think about it, from a household point of view, from the regular people, we've really been unchanged. If you go and look at the ones that they have to kind of fudge the data, the Bureau of Labor Statistics, we're up 256,000 jobs, but it's not showing that in the household survey. So take it with a grain of salt. So,
Right.
of course, the headline number comes out and everyone's jumping for joy. Look how hot the economy is. Okay. But you saw what happened in the market. And if the economy is so hot, we talked last week about it's taking longer for people who are out of work to find jobs. It's not just like a turnkey anymore. So I'm leaning more on the side of the household survey that the employment picture isn't all that well. And when you dig into these, you still see more part-time workers and full-time workers. and you all see more government jobs causing these jobs to go up. So anyway,
Yeah.
that's one half of the equation. Got anything to say on employment? Unemployment?
I mean, if you're a business and your consumer is tapped out and you're at all-time highs on 90-day delinquency rates on credit cards, you're not spending as much, which means the business isn't making as much. Um, you know, what's there more to say is, I'm not going to hire people I don't need. Um, I think, I honestly think we're headed towards a change in manufacturing in the next 3 to 5 years. That's going to eliminate the need for a lot of people. So we're just feeding into that long-term growth rate of employment, in my opinion, until we get back on good ground and we see the consumer spending money again in a big way. Um, I expect, I expect these numbers, the unemployment rate to eventually adjust and go up. And I expect corporations not to be hiring. So I think you'll more and more see layoffs. You'll see more consolidation and advancement in technology to replace the human laborer in general.
Here's the chart of non-farm payroll. And since back in March, I mean, we were looking steady for the most part. And then all of a sudden, I mean, we're all over the place. And
Yeah.
being an old quality engineer, when I start seeing data look like this, I know something's out of control or out of whack when we keep doing this kind of stuff. So we'll see what happens when they come in with revisions. But again, not looking all that good.
No,
Stack,
I think that's
stack, I mean, it's not looking, I mean, it's looking great as far as if you don't dig into the numbers, then you're fine.
well, everything looks great, Mark, if you just don't look at it.
Yeah, that's true. Well, just let Steve Leisman tell you what to think, and everyone will be happy. This
Okay.
was this is the PPI that came out today, and the PPI headline came out, uh, and basically it said the PPI rose. This producer price index rose 0.2% month over month, and was expected to be 0.4%. Woohoo! So everyone was good. The headline's good. Markets went up until you looked at year over year. The PPI went up to 3.3%, and that's up from 3% prior, but below 3.5% was expected. But it still went up, and that's the highest since February
Oh,
of 2023. The core PPI was unchanged month over month, leaving the year core flat at 3.5%. And so this chart here shows that with 4 years of data completed, we can compare PPI results from the past two administrations. You can see under Biden, producer prices tripled the pace they did under Trump, basically. So again,
wow.
you had basically under Trump, the PPI was about 1.9% on average
Yeah.
yearly, and under Trump, we're at 5.2%. So when we say everything's all right, we have not come back down to any level. We're still going up.
Well, and that's a misguidance of some of these monthly numbers is when you start to look out beyond a year, what you see in that chart is it costs more. Things
Yep.
aren't going down. We're not going back down to 120 on
Nope.
that chart,
Nope.
that's a problem. And
And
if
this
we
is and this
continue
is just
that,
for producers. Tomorrow we get the consumers. This is just producers.
yeah. But here's the problem with a lot of these. They take out energy and food.
Core. Yeah, because we don't use those.
Yeah. I mean, it's ridiculous that we're not looking at it going, what is the most used thing in this country? Food and energy. Bottom line, that should be the biggest weighting in these things. But most of it, like the CPI number, they'll take it out because it's so volatile. It's not
Yep.
volatile, it just goes up.
Yep.
I mean, come on. I mean,
Well, and then
hell,
they weight things differently too, like shelter over this, over that. I mean, for me, what are you paying for? You're paying shelter. You got to live somewhere. Part of
yep,
shelter is insurance. You got to have insurance. Ask the people of Southern California about insurance. You got to have a car. Car has insurance too. There's a cost of maintaining your car. Okay. Is that in there? And then food and heat and energy. You need energy to heat and cool your house. You need food to eat. Okay. Think about all those things. Let's take out energy and food. Okay. Because we don't need those. Again, they think we're stupid and we must be because everyone jumps around and is happy when Steve Leisman gets on there and does his little fairy dance, about how great everything is. And then all of a sudden the market tanks like it does today. Okay. Anyway, that's my rant for today against Steve. So
Yeah,
so now we've got tomorrow's CPI. We'll see what happens in the CPI, which is Consumer Price Index. And again, you'll see a lot of that core and all that stuff, and we'll talk about it, on Friday in our Zoom call, and we'll debunk everything that they say. But inflation's going up. I don't care what they say. The core has even gone up, okay, to
yeah,
3.3 year over year. So we're not going down. So you can get the headline number, say month over month, but year over year, we're going up.
yeah. It's
Uh,
it's it's that simple.
yep,
They should honestly. I don't think they should report the monthly. They should just report year over year, rolling
yep,
year over year.
yep,
If it's going down, awesome. Then you're
yep,
winning. You're doing your job.
yep. But they're not.
You know, but no.
All right, I want to talk about one more thing, and I'm not into this yet, but there's this growing debate about quantum computing. Okay. And I'm not a quantum computing guy at all or AI expert, but quantum computing stocks sold off yesterday after Meta Platforms CEO Mark Zuckerberg cautioned that uses for computers with these capabilities remain years away. I'm not really an expert on quantum computing, but my understanding is that it's still quite a ways off from being very useful paradigm, he said during an appearance with Joe Rogan podcast published Friday, adding that many people think technology is likely a decade plus out. These comments reinforce recent commentary from NVIDIA CEO Jensen Huang that suggests that computers are likely 15 to 30 years away. The news battered quantum computing stocks that have sold off following the booming 2024 on the heels of Alphabet's promising Willow chip announcement. Rigetti Computing, D-Wave Quantum tanked 20% each yesterday, building on last week's losses, and IonQ slumped more than 9%. So just be careful when you follow hype and momentum, okay, that as fast as it goes up, it can go back down. And then all it took was Jason Hong and Mark Zuckerberg to say, hey, these are 20 years off.
Yeah. Well, and you think about quantum computing as in what is it applicable to? The D Wave CEO came out after Jensen Young spoke about it, saying, "Oh, Mastercard and Visa are using it, but it's for a certain type of quantum computing. The quantum computing everybody's talking about is so much more advanced, and the applications are probably so much narrower. We were talking about on Friday's Kerry's call about NVIDIA's new computer for the consumer, right? And you and I spoke about it yesterday. And I'm like, first of all, most consumers use maybe 10% of the capability of the computer they have now, right? And you can buy a desktop or a laptop for less than $1,000. So if you're only using 10, 20% of the capability of that computer now, why are you going to go up to a $3,000 computer that is going to can do insane amount of things? And what would you have a purpose? What's the head of HR of a company have a purpose for that computer, you know? And then second of all, most people don't know how to even communicate with it to actually get it to do what they need to do, right? So the hype on NVIDIA's, 2-hour presentation at the what's that CES conference, I think it was,
Yep.
you know, fantastic. That computer will be fantastic for universities, research firms who are on a bit of a tighter budget. It'll be fantastic for them. But for you and I and the regular Joes of the world, chances are we have no purpose in it. We have no need, and we don't have the willingness to actually figure out how to use it in that light. On the flip side, what they introduced with robotics is a game changer. I think it is a place where you see growth. And I think this is where this whole quantum computing thing, if it's like, here's NVIDIA's new computer, and if I'm right about what I'm saying about NVIDIA's computer, quantum computing is here. It's out of the stratosphere. It's it's hype, it's headlines, it's built up gamma that popped those stocks up, made a bunch of people rich, and then they turned around and they've shorted them all the way down. They've made money. It's just too far out. And the applications in today's world, it's just too narrow right now. It's too narrow, and it's not there yet. They got an energy problem. They got to solve that first before it becomes a dominant thing.
Yeah, and there's
And
got to be a
that's
need. There's got to be a need for it on a bigger scale, I think. I don't
yeah,
need it. I barely, like you said, I barely can use the power of my laptop here.
right. Right.
So
And I think that's the thing is it's like where is that applicable to? Well, defense, you know, health, research. Okay. There's two of what, 10 different area sectors, 10 different
yeah,
areas that's applicable to. Yeah. I think there's just more, it's a ways to go. Just a ways to go. And I think when it comes to the consumer product world, what is the consumer needing and what will they need in 10 years? What will be in demand? You know, NVIDIA is addressing the whole gaming market again. That's how they started. That's how they grew their business. That makes sense to me. That makes a lot of sense because gaming is so big. Um, it can teach you a lot. A lot of applications can be taught in gaming in that world. To me, that's a good effort. But to think I'm going to put a $3,000 computer when I don't even use 80% of the capability of my laptop is going to change the game for anybody. I just don't see it. Don't see it.
there's Trent's
Look at
rants.
the charts, Mark. Look at the charts. There, Nvidia's rolling over. Look at the charts.
I
That's
agree.
that's where it is.
I agree. So now we got your rant out of the way and my rant out of the way. Let's talk a
Thank
little
you.
bit about stocks for the next year. And we did a little exercise on our platinum channel last Friday. We have a platinum call with the members. They got a little fun. Everyone brought three stocks or so that they wanted to that they thought were going to be good long-term investments for 2025. And so I'll start out with mine, and then Trent will do his, and then we'll show you what the rest of the gang did. But when I look at long-term investments, and I have long-term investment accounts, I have short-term uh, trading accounts for swing trading, and then I have accounts just for investment income where I either utilize it or I put it back in treasury bills or something to give me a little more money while it's waiting to be deployed either in swing trading or long-term trading. So when I look at uh, stocks, this is a chart we've looked at before, and this has really uh, made an impression on me. And this was from a lot of MicroStrategy and Michael Saylor's when he talks about few asset classes outperform monetary inflation, and monetary inflation is caused by printing money. And of course, we've been printing a lot of money. And according to his records, consumer inflation is like the CPI and whatever. If you believe that we're only at 2 to 3%, that's fine. We're probably, if you went to a grocery store, you saw a lot higher than that. But monetary inflation brings us up, between 12 and 13 and 14%. And regular assets, if you're just in the SPY, you break even basically. You're in US growth, okay, which is basically the Mag 7, along with the NASDAQ, you're making 4.5%, maybe 5%, on top of a monetary inflation. And then if you look at different segments and you add in Bitcoin over the last 4 years or 14 years, you can see the return versus 4 years of Bitcoin. This is 14 years of return. This is the last 4 years of Bitcoin, which is 60%. So annualized asset performance over the last 4 years, if you were in bonds, like Trent said before, you're losing money. Gold 6%, real estate 10, S&P 15, Mag 7, 29%, and Bitcoin 60%. Okay, so that kind of got me thinking, and so when I think about long-term investments, my goal in long-term investing is provide annual returns in my account greater than that of the monetary inflation, which is 12.5, 13%. And my goal would be, of making over 20%. And so the stocks that I chose were, number one, it was my old favorite and long-term investment, Berkshire Hathaway. And Berkshire Hathaway is a multinational conglomerate holding company that's headquartered 60 miles from where I'm at. They operate across diverse ranges of industries, including insurance, railroads, utilities, manufacturing, consumer products, retailing, uh, real estate, finance. Okay, they have a deep stock investment portfolio that includes Apple and American Express, Bank of America, Coca-Cola, Chevron. They also have Oxy Petroleum, Citigroup, Chubb, Kraft Heinz, VeriSign, uh, Alley Financial, Louisiana Pacific, Domino's Pizza, Pool, NBR, Lennar, Ultra Beauty, and they even own part of the Atlanta Braves holding company. And on top of that, they have over $320 billion in cash reserves. Uh, so $320 billion of reserves, why would he hold so much money? Well, the last time he held anything close, it was right before, I believe, the great financial crisis. So to me, he's looking at his own Buffett indicator and saying, look, I'm gonna have some dry powder. When the sale comes, I'm gonna be ready to buy it. And since Warren Buffett took control of Berkshire Hathaway in 1965, the company has significantly outperformed the S&P 500. He's achieved a compound annual growth rate, or CAGR, of roughly 20%, and the S&P has achieved a CAGR around 10.2% over the same time. So that's why I've been a long-term holder in Berkshire, and I will. Berkshire is one of my choices this year. The second choice I have is Bitcoin. Okay, for obvious reasons. So you can trade either Bitcoin and raw Bitcoin, and you can go to Coinbase or any exchanges and buy it straight out. You can take custody of your Bitcoin. If you have a IRA or just a regular trading account, you don't want to take custody or any of that. You have the ETFs, and so I choose either Bitcoin or IBIT, the BlackRock ETF. And why do I like Bitcoin? Supply and demand. It's highly desirable but scarce digital capital. There's only 21 million, 19.5 have been mined, and the demand is very high with all these ETFs out there. And now we're talking about governments putting reserves out there, whether they're state, local, or national governments. And then you've got institutionals buying them. There's just a huge demand out there. Companies adapting them within their treasury strategies. Countries in 16 years now, it's the seventh largest asset class by market cap, behind gold. Okay, so it's not going anywhere as it's now a big asset class. It's the strongest asset class for 11 of the past 14 years. The average rate of return is 168% over 14 years and 60% over the last 4 years. So I see that for me, and for most people, it's a risky, highly volatile uh, position, but there's ways you can play it. BlackRock's now out there saying 2 to 3% of their clients' portfolio should be in some type of Bitcoin, either in IBIT, or Bitcoin. I also use MicroStrategy, which is a leverage play. But again, it's not for the faint of heart, and you should really understand it before you get into it. And then the third aspect that I would look at is stick with what we got. We got the mags out there, and they're still, if you go back, that's where all the power and the juice of the market's been. And there's an ETF out there called Mags, and it invests in the Mag 7. Now, when I get into it right now, I look at the charts. Charts tell me not to do that. But if this takes off again and revenues move up forward and expectations and forward guidance goes, you can see the mags take off again, and they will return me historically, looking back a couple of years, more than the 12, 13% I need to get past monetary inflation. So those are the three areas I'm looking at: Berkshire Hathaway, Bitcoin through either MicroStrategy, IBIT, or Bitcoin itself, and then the mags. You can either go, with individual stocks of the mags, or you can go with the mags itself. But those I would be looking at right now because the markets have kind of rolled over, and I wouldn't get into them right at this moment, but I'd keep them on my list, depending on how the markets go this year. So that's what I'm looking at from a long-term point of view. I own all those except for the mags right now. So Trent, what do you got?
So I've got three as well. Meta is my first pick. I like what they're doing with AI and their advertising platform. They're going to drive the costs and the effectiveness of advertising on the Meta universe through WhatsApp, Messenger, Instagram, Facebook. I think their effort into it was sort of Johnny come lately, so they had a introduced a open architectural platform for which anybody could contribute to the AI code, which is I believe called Luna. And I think that's a very powerful way to accelerate your growth or your um, gaining ground in AI or really any programming is to open it up to the universe of programmers and have them contribute their thoughts. And the great thing about that is it doesn't cost them anything. So the cost to develop it and what they've done since doing that has really jump started their advertising and AI program. If you're a small business, or even a large business, you can advertise on Facebook and you can turn it over to them, their AI program, and they'll optimize your ads. They'll, retarget your market for you. And I honestly I think they've got 1 million people right now using it. I think that to me is a very in the world of social media platforms and advertising that will give them a leg up. They're addressing the data center element, and I think they're smart in that they've just recently broken ground or they struck a deal in, I believe it's Rockville Parish, Louisiana, which is just off the I-20 corridor, interstate corridor, which is one of the main internet backbones of our country. And they went there because of energy and water. To run a data center, you have to have energy. Louisiana has it. You have to have water to cool it. Louisiana has it. So I think overall, Zuckerberg's, along with some decisions to get rid of this policing of Facebook, I think they realize TikTok has taken them out to the woodshed on this. They're reducing the basically the handcuffs they put on what can be put on their platforms. And I think they're in competition with TikTok if it sticks around, if not with X, because it just came out recent or today. I saw where China has hinted at they would be willing to sell it to Elon, which means that would become part of the X platform, and that would give, I mean, Elon's whole universe of companies another, feather in its cap. So I think what Zuckerberg and Meta is doing is they're upping their game. They're going to use AI more and more towards the enterprise side of it, so corporations. And I see a vast amount of opportunity there with Meta when it comes to that. They're looking at the whole landscape and they're going, how do we use this technology to grab more market share, both in the consumer but also in the enterprise environment? The second one is Tesla, and it's really not on Tesla cars. It's more on what Elon Musk is doing with robotics, Starlink, which is their satellite company. As that grows and as um, ties loosen up on Tesla or on his ability to offer Starlink to other parts of the United States in the country in the world, I think Starlink could become one of the most powerful internet providers in the world. And right now, I think they provide it to about 4 million customers. It could just be a cash cow for Elon in general. Tesla's robotic, development, I think that as fast as Elon brings products to the market and the efficiencies he does, I think the robotics arm of it could be really incredible. I was talking to a relative who owns a manufacturing company a couple weeks ago. He said the minute I can buy 100 of them, I'm taking out a loan and I'm buying 100, and then I'm going to take out another loan and buy another 100. And I see that changing, robotics changing the manufacturing world in the United States, making it more affordable to manufacture products here versus sending it to China, which would cut our dependency on China. And since they are, as the United States has deemed them a enemy of this state of our country, the more and more need for manufacturing in the United States is going to be needed. And robotics is going to be one of those areas to create efficiencies. And then the third one, I see you have the chart of Tesla up here. Tesla, in my opinion, do I own it right now? No. Do I own Meta? No. I'm looking for a better opportunity because when I look at the charts here, I go, it's rolling over. There's going to be a better opportunity down the road to buy Tesla. As a company, I think they're solid. I think what they're doing is incredible. As a stock price, I think it's overvalued. And I think there is a better place to buy it. And so that's why I really focus on the charts and the technicals as you do, Mark. And what I look at here is your RSI, your MACD, your slow stochastics are all in that going over the right side of the bell curve kind of thing, as is the stock price.
This is a weekly chart.
Yeah. And then my third one is high yield debt, HYG. This is a second half of the year idea. Um, HYG represents high yield bonds or high yield debt. It's an ETF. I the first half of this year, I think will be a rocky road. I think you're going to see, as we're seeing with the 10-year Treasury, as well as high yield debt, yields are going up, which causes the bond values to go down. So like HYG is going, rolling over, TLT rolls over, IEF, which is the 7 to 10 year, 10 year or 7 to 10 year bond, U.S. Treasury bond ETF. They're all rolling over. These yields are going to get to a point where they become really attractive versus the stock market. HYG is a higher risk, higher beta play. I see it as a second half of the year opportunity, but I do see that if we see a rollover in yields, I mean a rise in yields, continue rise in yields, continue questioning of corporate and U.S. debt, these yields are going to go higher, driving these prices down. And I think at some point, as we have a recovery, high yield debt could be just a really big banger for the buck. You get paid to wait, and you get that upside move. We saw it in '08 when I was a financial advisor. We rolled a significant portion of our fixed income portfolios into high yield debt. And in 2009, we returned about a 39 or so percent return in high yield in just using that ETF for clients, which caused more questions about how did you make me money in a bad year? So, which is a great feeling, but that's strategically, that's how I'm looking at HYG. So, as I said, these three positions right now, are they a buy today? No. No, I'm looking at the charts and I'm saying no. I'm looking at the economy. I'm saying no. Just sit on the sidelines and wait. Just wait. I know the two, Meta and Tesla, are going to be significant players in the next 24 to 10 years, if not beyond. Um, and I think they're setting themselves up to partake in that. High yield debt, it's a trade. I'm looking for an opportunity. So those are my three. Now, number of the Pride members also participated in this call on Friday and gave their stock ideas. And I'll show you those here. Let's pull this chart up. So when you go to the Best of US Investors Platinum channel, if you're a subscriber, you can click on the button. You can see the different positions, who contributed to them. We're still taking a couple until probably Friday because some of the members weren't able to participate. But you can see really a diverse selection, and I was really proud of the group for coming to the table with something a little different. Some of them were very optimistic in areas, a lot of, a focus in AI, technology. Others were very pessimistic about markets. And so you see places like, Mike in here saying about silver and gold, along with another sort of a hedge with Targa Resource Corp. You had your Bitcoins like yourself, some mining companies, Iris Energy. I mean, excuse me, Bitcoin mining slash data center with Iris Energy, as well as Mara Holdings. Then Esther came in. This was really cool with Reddit. She said she uses Reddit every day. She knows it. She understands how it can be a valuable tool, and so that was one of her picks. Um, and then Palantir, and then Scott came to the group with Urban Outfitters, which I think took you and I both back. Like, I didn't even think about retail. Um, they are a power, they're a organization that's deep into my kids' world, teenagers and clothing and all lifestyle type stuff. PayPal was another one Scott hit on. Made a lot of sense, and I can see how PayPal could probably position themselves as a global money transfer company in the more so than it is today. And then we have a couple, Paul came in with Palantir, AI driven Spotify, which is that radio that I have been subscribed to for 10 plus years. And then Solana, which is a cryptocurrency payment transaction platform. So really a diverse grouping of positions that I thought I was actually really proud of the group and impressed with the ideas that people have come into the channel with. So what do you think, Mark?
I think it's going to be fun watching this, and then next year we'll see who did what and how well it worked.
Yeah, exactly. And this is a as of January 10th close of business. These were the prices that we're starting at. So you're going to be able to see that, and then you'll see today's price. This updates every 20 minutes throughout the day, so you can see how it's doing. I mean, Scott nailed one here. I didn't even know what this company does. OPFI. It's already up 13.58% since Friday. We all know that, be cautious of that, but who knows what it'll look like in 12 months.
Yeah.
But yeah, so that you're able to come and look at this and see how this perform overall year to date return will be. We're actually positive as of this morning, so just a bit, but yeah, I think this is exciting, and we're looking for Platinum members can comment on the Discord about it. They can bring news stories about this, post it up. So I look forward to our Friday calls where we review this and we talk a little bit about it. So it's pretty cool.
Yep, it is. It's just another membership benefit for platinum members.
Exactly. Exactly.
So,
Very cool. Well, Mark, got anything else you want to hit on?
oh, I think I'm all stocked out right now. We'll see what happens tomorrow on the CPI.
Yeah.
So, again, take it with a grain of salt. If you want, dig into it a little bit and learn how to look at these reports and be a little skeptical because I certainly am. I don't take anyone's word for what's going on except my own and what my eyes see. So, you know,
Yeah.
what I want to do, and it's my money, not theirs, and I want to make sure that I risk manage appropriately.
Yeah. And I think that's you and I were talking prior to the, jumping on this call about what is platinum. And platinum is about using technical analysis to create wealth. And that is the focus. If it's long term or short term, as we showed you, we've got a tribe. Our platinum tribe members contributed their ideas for the year. That portfolio ain't going to change. We're not going to buy and sell it or anything like that. There's none of that. It's just buy and hold. But teaching people how to use technical analysis to preserve capital, just simple techniques, along with on short term side of it using technicals to profit from short-term moves in the stock market. So that's what we're all about. we'll wrap it up here, and hopefully it'll warm up here soon for most of the country. And I hope those people in California can find safety and some peace of mind, because I know probably a lot of them are losing their minds right now. And I hope there is a easy solution to their rebuilding problems. I hope the reports of 3 year waiting 3 years for permits to rebuild their homes is not going to happen. I hope it's an expedited thing and these people can get back to living life, you know? So in the meantime, y'all have a great day. I am Trent and this is Mark over here, and we are two regular guys on Best of US Investors. Come check us out at bestofusinvestors.com or bust13.ai. Go to the Platinum channel, try us out for 14 days free, and subscribe. In the meantime, have a great day and always live loud. See ya.